Welcome everyone. My guest today is Marina Walsh, Vice President of Industry Analysis at MBA, and we are here in person at the MBA Servicing Conference to talk about her housing market outlook. Very excited to dive into this. First, I want to say thank you to our sponsor, Trust and Will, for making this episode possible. Marina, thank you for being here.
Sarah, it's always a pleasure to join you.
Well, we're thrilled. I wanted to talk to you about the market update that you gave today. Overall, what's the high level message here?
The high level message is that we're expecting originations at least to increase a bit to by 8% to 2.2 trillion. So that's good, leading into it. But the whole idea of a K-shaped economy, I think, is alive and well. There are certain groups that are doing very well. Certain people are doing very well. High income, they've made a lot of money in the stock market. They've accumulated home equity. Perhaps they got their mortgage pre-pandemic. They're doing really well. But then you have the others that are really struggling. They may have additional consumer debt. Consumer delinquencies are moving up a bit. So it's a little bit of a mixed picture in terms of what's happening. Certain sectors like healthcare doing very well, others aren't. So it's not it's not sort of a clear path forward, I would say, in terms of where things are heading.
We see that in the labor data, right? You see the labor data where like healthcare had a great 2025, if you want to look at that. Other sectors not, and of course those are the consumers that we're all selling to.
That's exactly right. It's different based on age too. Obviously, the college graduate is not necessarily thinking about buying a home, but that sector. Those recent college graduates, the unemployment rate is really high, so that could have repercussions further down the way in terms of mortgage. So,
I think I've been reading that the recent college grads is kind of a very tough market for them.
Oh, Sarah, I can tell you about it. I have a college senior who had a second job, trying to get a job in addition to his schoolwork. But happy to report he did get a job. But it's tough out there.
That is happy news. So one of the things that people think about right now, and obviously have for the last couple years, is that rising FHA delinquency, right? So we'd love for you to talk a little bit about that and what you see there and why there is that, bigger gap now between FHA and conventional.
Yeah, I mean, that gap between FHA and conventional is sitting at it's pushing 900 basis points. Wow. And the FHA rate, if you don't consider that COVID period of time when delinquencies really peaked, you'd have to go back to 2011, 2012 to get to that level, of about 11.5, a little higher than that FHA delinquency. So the question is it going to stay like this? What are the causes? And one of the causes, obviously, is just the change in the FHA loss mitigation protocols. So we used to have these COVID protocols that were finally sunset at the end of September. So that makes some difference. But we were seeing delinquencies going up even before that. So there's more involved. And that leads to our discussion about, the labor market and who's most affected by it. And or another big a factor in these delinquencies is when the borrower got their mortgage. So if they got it in 2020, 2021, when mortgage rates were a lot lower, then we're seeing lower FHA delinquencies in certain years versus when they were really stretched and just barely got into that home. And so any little or big life event can really trigger a delinquency.
Which makes so much sense. What do you think people should be looking for in their portfolio? What should they be looking out for?
Really pay attention to the state-by-state information.
Okay.
I use the example of my hometown, which is called the DMV district. Maryland, Virginia, and how different the FHA delinquency rates are between those three areas that you'd think that they'd be similar, but they're not. And so looking at the state-by-state information, looking at what's happening in terms of the economies in those particular states. Obviously, you got to pay attention to property insurance and taxes in each state. That's going to be a layering stress. I don't think that's exactly a cause of delinquency, but it's an additional stress if a borrower experiences any other type of financial hardship. I think that's a factor.
So are we seeing, I went to the session yesterday too on, FHA, VA, and with Jenny May, and they talked about the serious delinquencies is where we're seeing some of the stress the most.
And we're seeing the same thing in our national delinquency survey data, where the 30s and 60s have moderated a bit over the last few quarters, and it really is the seriously delinquents. Now, some of those seriously delinquents could be in a trial payment plan right now, and so they just have to get through those trials. We have to see how those TPPs do in the next few quarters to see how bad things could get. Now, we haven't talked about VA, but on the VA side, we really need some guidance. We really need to get that started. There was legislation passed to have a partial claim program. Hopefully, implementation of that program will be forthcoming soon so that there is an option for VA borrowers too.
Great point. Do you see, I know in the last couple of years, what we've talked about is there are people who are in that delinquency, sequence, they're late, they're whatever, and then they're in loss mit, and then they get out, and then they're back in. Are you seeing those kind of things happen still?
Yes, actually, we track it in our loan monitoring survey based on our data for all workouts. So this is conventional, FHA, VA, all together. About 30% of those workouts, those borrowers in the workouts have had a previous workout already. So they're kind of vulnerable. I hate to think that they're all just trying to churn the system, so to speak, but they are more vulnerable and more likely to default again and seek another workout. And I think that's part of the reason why FHA basically put a halt to the COVID protocols and said, hey, this is back to business. We have a fiduciary responsibility. Right. So, yeah.
That makes total sense. Well, let's talk about foreclosures. What's actually getting all the way there? Where are we?
Yeah, okay. So there's not a bloodbath in foreclosures yet. There was a period of time where foreclosures were nearly zero. Right. There were no foreclosures happening. And then the headlines began, foreclosures have doubled and tripled. Right. So we have to be very careful about it. I mean, foreclosures are sitting at about 0.53% of servicing portfolios is the overall number. Higher for FHA and VA loans, but that's where we are. And I think the industry average, or the average going back to 1979, can you believe it? Our NDS goes back to 1979. But if you look at that trending from 1979 to the present, 2025, it's averaged about 1.36%.
Okay, so we're
of
still
portfolios.
Way down.
Yeah. Below, over 2 times higher is what that historical average is. That said, we are seeing increases, and I think it's really important from a staffing perspective that servicers prepare for foreclosures because we've been out of foreclosures as an industry for so long. There have been loss mitigation options. The focus has been on home retention, almost more so than loss mitigation, perhaps, right? It was about keeping the home. And, obviously we still want, servicers want borrowers to be able to keep their home. But at the same time, there are instances where it just does not make financial sense. Perhaps the borrower can get some of the equity. They're still in an equity positive situation, and it could potentially be better for them to leave. So all this to say, foreclosures are going to go up, and staffing is going to be really important. There were a lot of, for instance, foreclosure attorneys, Sarah, that just left because there was no business. And so
Right.
it's almost like you got to get the band back together. You got to get people trained,
Yeah.
and have the vendors in place to either work through, a pre-foreclosure, some type of pre-foreclosure sale, or the full foreclosure. Yeah.
But I was just going to say, we know we have shed all these jobs in the industry. How many of those were like, we don't need you, foreclosure expert. We have zero foreclosures, and then it's like, what do you do now?
I know. Got to bring them back to the extent you can, and/or use technology to some extent. I think in terms of just overall staffing could be helped out by technology, artificial
True.
intelligence, in terms of understanding all the program guidance, for instance. I hear that a lot, understanding the regs, the policies for particular loans. That's really important. So it helps out to some extent, but at the same time, we're in a service business. It is
Good
called
point.
the servicing business, and a lot of it, each loan has its own unique set of circumstances. Each borrower has their own set of circumstances. So it's still people driven to a large extent.
People driven. Well, pivoting a little bit. Okay, trigger leads. That the trigger lead ban
Yeah.
goes into effect here pretty soon.
That's
What does
right.
that mean to the servicers who are here?
It means that they have an opportunity, for sure. And I think a lot of the M&A activity that you're hearing about recently, you could say, oh, it's for economies of scale. But I think a lot of it has to do with recapture and positioning.
Yep.
Certain companies are positioning themselves for that recapture business. So it certainly is an advantage for those that service loans, and the numbers are pretty abysmal right now based on what we're seeing with recapture. We're talking about a rate of about 20%, meaning 1 in 5 borrowers goes to their servicer for that new loan. So there's a lot of room for improvement. There are many definitions of recapture,
Right.
but based on our data, we're talking about 1 in 5.
Well, and I've been coming to these conferences for years, probably a decade now, right? And that recapture rate hasn't really gotten any better. I mean, it's always like 19, 20, you're like, wow.
It did get better, actually.
Okay.
This is the best it's been since 21, but I fully expect for full year, and that's only half year data. So for full year 2025, when you think about refinancings really picking up in the second half of the year, I think we're going to see that recapture move up. And again, folks are getting smarter. There's predictive analytics. There's more data mining. There's just more data available
True.
on borrowers who could potentially be a candidate, for a refinance or a purchase. So I think we're going to see a lot of movement. There's
Well, and
plenty
then
of
if you are not a servicer, if you're an originator who doesn't have servicing, then it's an opportunity for other people. Maybe it's you're going to have to step it up.
Yeah, the legislation specifically carves out not only a piece for the servicer, but if you were the original, if you originated the loan, or if you're a bank, it could be an advantage for banks. If you have an existing relationship with that particular borrower. So there are others who could be involved, but it's moving it from a field of perhaps 20 different organizations down to a handful. Yeah.
Which on the consumer side, we would all appreciate that.
Yes,
please.
we certainly would. We do not want to hear from 20 lending institutions.
You mentioned AI earlier. I mean, it's either like, I was just talking to someone at lunch, actually, and he was like, it's either like the apocalypse, it's like Skynet, or it's like, oh no, nothing even works. It's not a big deal. Like, where's the truth of the AI here?
I do think it needs guardrails for sure, but of all the demos I've seen at this conference, we had a whole segment, a
AI
whole
labs,
track,
right? Yep.
Dedicated to it. I think it's real. I think it can be used very inappropriately, but I think that there's a lot of benefit potentially to mortgage servicing in terms of gleaning efficiencies, especially when it comes to so many different products out there right now. You have loan products that have a down payment assistance program, down payment attached to it, or HELOCs, or ARMs are moving up. There's more ARM share than there was before. All these different products, construction lending. I do think that there could be the opportunity. It's just, I think it's hard for servicers to know where exactly to look, and how to best utilize and utilize AI appropriately, so that there are all sorts of privacy issues associated with it. But I think at the end of the day, it's just a new frontier. Yeah.
I like the approach you guys took at this conference to have all those AI labs where it's like very specific.
Yeah. I just came to an AI lab, and let me tell you, I need a tutorial in AI 101 because.
Well, if you do, many other people would as well. I know that's true. Well, thank you so much, Marina. I appreciate you sitting down as always and walking us through the whole picture. I appreciate that.
Oh, thanks, Sarah.